Welcome back. So far, we've dived into stock strategies based on things like momentum and value. Today, we're going to bridge the gap between old-school chart reading and the super modern world of machine learning to see how traders try to get an edge on the market.
All right, let's just get right into the big question here. We're stepping into the, let's call it, controversial world of technical analysis. You've got quantitative traders who absolutely swear by these tools, convinced they can spot real patterns in market behavior. And then you have a lot of people, especially in academia, who basically think it's all nonsense.
And here are those two camps, side by side. The academic view is pretty clear. Markets are efficient, all the info is already baked into the price, so looking at charts is like reading tea leaves, it's just random noise. But the quants have a totally different take. They'd say, look, we're not trying to predict a company's next earnings report, we're trying to model the people trading the stock. They believe these patterns actually capture the market's collective mood swings, the fear and the greed.
Okay, so let's start with the most fundamental idea in all of technical analysis, just figuring out which way the wind is blowing and following the trend. And the main tool for that job is the moving average. The simplest approach here uses just one moving average, or MA. All it is the average price over a certain period, like the last 50 days. What this does is it smooths out all the wild day-to-day jumps and drops so you can see the real underlying trend. The trading rule itself is dead simple. If the current price pops above that smoothed line, that's your signal to buy. If it dips below, it's a signal to sell, or even bet against it. Now, things get a little more robust when you add a second moving average. Instead of comparing the price to one line, we compare a short-term or fast average, say a 10-day, to a long-term slow average, like a 50-day. The signal to buy only fires when that fast, zippy average crosses above the slow, steady one. It suggests a new upward trend might really be taking hold. You'll often hear this called a golden cross.
Of course, trends can flip on a dime, so to handle that risk, traders will almost always add a stop-loss rule. Think of it as your automatic ejection seat. So even if your moving averages are screaming buy, you might have a rule that says, if the price drops more than 2% in one day, I'm out. No questions asked. It's an emergency brake that can save you from a disaster.
And you can get even more selective by adding a third moving average. This creates a much stricter rule for getting into a trade. You only go long if all three are lined up perfectly. The fast is above the medium, and the medium is above the slow. It's like waiting for 3 green lights before you hit the gas. It helps you avoid jumping on trends that fizzle out right away.
All right, so that's trend following. But what if the market isn't really trending at all? What if it's just stuck, chopping back and forth? Well, the next batch of strategies is all about profiting from those kinds of environments.
A super classic technique for this is calculating what's called support and resistance levels. You take the high, low, and closing price from yesterday to calculate a central pivot point. Then you project out a price floor or support and a price ceiling or resistance. The basic idea is to buy the bounces off the floor and sell when the price smacks into the ceiling.
The Donchian channel is a really neat way to formalize that idea. It just draws a band around the price. The top of the band is the highest high over the last, say, 20 days, and the bottom is the lowest low. The strategy here is pure mean reversion. You're betting things will go back to the middle. So you buy when the price touches the bottom of the channel and sell when it hits the top.
Now, not all quantitative strategies live and die by the price chart. Some of the most well-known ones, like merger arbitrage, are driven by very specific corporate news.
Okay, so when one company announces it's buying another, the target company's stock price usually jumps up, but not quite all the way to the deal price. That little gap is the opportunity. If it's an all-cash deal, the trade is simple. You just buy the target stock and wait. But if it's a stock-for-stock deal, you have to do this clever thing called a pair trade. You buy the target company's stock, but at the same time you short sell the acquirer's stock. This isolates you from the overall market going up or down. You're only betting on the deal itself.
Let's just walk through a quick example so this makes sense. Let's say the deal is 2 shares of the acquirer for every 1 share of the target. So you short 2 shares of the acquirer at $35 each. Boom, $70 in cash appears in your account. Then you take 67 of those dollars and buy 1 share of the target.
So what are you left with? You're left with an instant cash credit of $3. And that $3 is the whole point. That's your potential profit on the trade, which you get to keep if, and this is a big if, the deal actually closes.
Right. There's always a catch, isn't there? This is definitely not free money. The entire trade is one big bet that the merger will go through.
If regulators block it, if shareholders vote no, if anything goes wrong and the deal breaks, the target stock price will probably crash. That price spread blows up, and your $3 profit can instantly become a pretty painful loss.
So all this risk and the rigid nature of these handmade rules, it kind of brings us to the next logical step in this whole evolution. What if we could stop trying to define these patterns ourselves and instead just teach a machine how to find them for us? And this right here is the fundamental question that connects everything we've talked about to the world of machine learning. Instead of us deciding that a 10-day average crossing a 30-day is the magic signal, what if we could just feed a machine all the data and let it tell us what patterns matter most?
One of the most intuitive algorithms for this is called k-nearest neighbors, or KNN, and the idea behind it is just so simple and powerful. To predict what a stock might do tomorrow, the algorithm literally sifts through all of history to find, say, the 10 past days that look the most like today based on dozens of variables.
So here's how it works. First, you define your predictors, things you think might be important, like recent returns or volatility. Second, you define your target, what you're trying to predict, like the return over the next 20 days. Then the algorithm does the heavy lifting. It calculates the mathematical distance between today's setup and every other day in your data set. It finds the closest historical matches, those are the neighbors, and then it just asks, okay, in those cases, what happened next? Your prediction is simply the average of what happened in those past situations.
But the big question is, how many neighbors, how big should K be? This is a classic problem in machine learning called the bias-variance trade-off. If you pick a really small K, like just 3, your model might be super noisy and get thrown off by weird one-off events. That's high variance. But if you pick a huge K, like 500, you risk averaging away the very subtle pattern you're trying to detect. That's high bias. Getting that balance just right is the secret sauce.
So let's just take a quick second to recap the journey we've been on. We've really gone from these simple, almost intuitive rules of thumb all the way to some seriously sophisticated, data-hungry algorithms.
I mean, think about the evolution here. We started with simple moving averages just to get a sense of the trend. Then we looked at trading inside of price boundaries, like channels. Then we jumped off the chart completely to trade specific corporate events. And all of that led us here, to using algorithms like KNN to have a machine do the pattern finding for us.
Ultimately, the real defense for any of these strategies is that they're not some kind of magic crystal ball. They're just attempts to use math to model human behavior, all that fear and greed and herd instinct that really drives the market. And from that perspective, machine learning isn't some crazy new thing. It's really just the next logical step in that same exact quest.
And that leaves us with one final, pretty massive thought. Everything we've covered today generates a signal on a single stock. But identifying a signal is one thing. Taking thousands of these noisy signals from thousands of different stocks all at once and trying to combine them into one optimized, risk-managed portfolio, well, that's a whole other level. And that's exactly where we're going in our next explainer.